What if I told you that the biggest American mortgage isn't a bank, but it is the Federal Reserve? Would you believe? Most people think that the Fed only sets interest rates and also buys US Treasury. They have no clue that the Federal Reserve is one of the biggest players in the American mortgage market. But here's the truth. They also own trillions of dollars in the American Mortgage-Backed Securities. That's the MBS. After the 2008 and the 2020 pandemic, the Fed stepped in to buy a large amount of mortgages to stabilize the housing crisis and also to reduce the interest rate. That means whether you're a borrower or an investor, the Fed's silent movement in the mortgage market directly impacts the rate you buy and also the way you underwrite your deal. This is very important for everyone, regardless of the fact whether you are into multifamily or you are into other forms of investment. Interest rate is something that broadly affects a lot of deals. So this particular episode is for every one of you that are into investment. So let's dive right in. Hello everyone, my name once again is Bibi Ofuri and I teach people how to be financially free with Multifamily. Most people think of Federal Reserve only in terms of interest rates and also buying of securities. But they do not know that the Fed is actively involved in the mortgage-backed securities and they are heavily involved in it. Although they are not in the headlines, all these things are in the background. But as an investor, it's important that you are aware and you position yourself and take advantage of any opportunity that this will bring to you. One of the reasons why I'm talking about this is that there's no fire without the smoke. Recently, it's something at the background that the Fed might be coming in to support mortgage-backed security. I don't think that will happen anytime between now and May because of who is the current chairman of the Federal Reserve. But as soon as his tenure is gone, it's possible that the new person there might be interested in doing exactly what this administration wants, and that is for the Federal Reserve to come in to support mortgage-backed security. Although they are heavily involved in it, currently they are about $2.4 trillion. I'm going to give you some historical data. If you've been watching me, you know that we always give things with facts and figures. So now let's dive into the history and data on periods where the Fed has stepped in to stimulate or to support mortgage-backed securities. So when I say MBS, I'm just referring to mortgage-backed securities. So I'll be mentioning the acronym. I might not say the full terms. Understand that anytime I'm saying MBS, I mean mortgage-backed securities. The first time the Fed decided to purchase mortgage-backed securities was during the 2008 crisis. It bought over $1.7 trillion mortgage-backed securities. The goal at that time was for them to push down mortgage rate, restore confidence, and stimulate lending when credit market froze. That was the idea. That was why they had to step in. It was a lot of money though. This is one of the reasons why they are one of the biggest mortgage-backed securities compared to many banks. The second one was during the 2020 that just recently passed when we had the pandemic. The Fed again stepped in, buying over $580 billion mortgage-backed securities. This helped bring mortgages back to record low. I can't remember when last we had 0%. We're seeing mortgages at 2%, 3%. Most of them were below 3%. And I know some of you experienced it because I did. The reason why you had that was because the federal government had to step in to buy about $580 billion of those mortgage securities. This helped mortgages to record lows, and this really supported the housing market during the uncertainties. And the next one happened recently that most of us are not even aware of, which was in 2022. The Fed reversed course. So rather than investing or purchasing those mortgage-backed securities, they decided to start tightening it up, which is called quantitative tightening. That is when the federal government starts pulling or withdrawing securities or funds from the economy. I've spoken about this before. If you've not watched my video on quantitative easing and quantitative tightening, now's the time for you to go watch it to understand what those terms are, because these are some of the tools that the Federal Reserve uses to control interest rates, inflation, and other things and stimulate the economy. So you need to go watch that video for you to understand what quantitative tightening is and what quantitative easing is. But in 2022, the government was using something called the quantitative tightening, whereby they stopped injecting or purchasing mortgage-backed securities. So rather what they were doing was not buying more, but allowing the current securities that they buy roll off its balance sheet. What that meant was that they stopped doing mortgage-backed securities. So the ones that they currently had, they just allowed people to be paying down the principal, and before you know it, to start going down. But the implication about that was that it's going to take a longer time for the entire mortgage-backed securities that the Fed has bought to clear off its balance sheets, because people that bought record low are unlikely to sell or to refinance because they have a very good rate. So you know yourself, most of us, or most of you, including me, that bought properties when it was record low just a few years ago, those houses are not up for sale right now. They're not selling. Except if there's something wrong with the property, or maybe it's faulty and all that. But if everything is good, I guess some people are like me, they will not be selling those properties. So despite the fact that they are doing something called the quantitative easing, they still have about $2.3 trillion in the mortgage market. So that is significantly high, despite the fact that they're still tightening up things. A federal paper or report shows that the Fed might still be holding on to about $500 billion in a decade to come because of the low interest rates that people recently purchased. That is, so many people might not be willing to sell off or refinance in a decade to come. Based on that research, that quantity might be about $500 billion. That is a lot of money. It is billion with a B, guys. It just shows that they're still going to be involved in the mortgage-backed securities. And not to even say it, there's the news out there, because this current administration is looking at how to support more housing, stimulate the housing market and all that. And these are one of the things that's on the table. Don't say I did not tell you. These are one of the things they're considering, that the Fed might begin jumping to stimulate that part of the sector. So let's look out for it. Let's watch out for it. By next year, if anything happens, we'll be there to definitely update you on that. What exactly is happening now? Yes, it's on the news that they are pulling out, they are withdrawing, but guess what? Despite all that we're hearing, the New York Fed continues to run mortgage-backed securities at the background. It's not out there. The New York Fed is doing it. Although it's relatively small, it's about 70 to 80 million per deal. So it's currently happening, but in a very small quantity, and there's no noise about it. It's in the background. So little by little, they're still stepping in to do one or two things, but not as significant as they would have done. That is happening to date, guys. What that does is that it shows that the government is a major player in the housing market, because the pace of runoff is relatively slow. What that means is that before people will decide to sell or refinance and pay back those monies, or the Fed will be able to retrieve back those monies, it's going to take a long time, because most people are not ready to sell. It just shows that the Fed is going to be in it for a long time. So you'll be wondering, why is BB telling us all this? How does this concern or impact us? It does impact you. It's a big deal, guys, because of mortgage rates and spread. So let me break that down. What does that really mean? When the Fed steps in and decides to purchase the MBS, what that does is that it narrows the spread between the treasuries and the mortgages. What that means is that less Fed's demand for MBS, it means higher mortgage rate. That is, if they don't get involved, we are likely to see very high mortgage rates. Maybe that is why this administration is talking or saying things at the background. For those of you that are attentive, I'm sure you must have been hearing it, that they are looking at stepping in, because if they don't, the mortgage interest rates will go higher. This is why it should concern you, because of how they can breach the spread between the security and the mortgage securities. And the second reason why this matters is because of housing market liquidity. The Fed's interference provides stability to the MBS markets, that is the market-backed security. So they play a significant role if they step in or they get involved, especially when private buyers hesitate. During the pandemic period, if you wanted to take loan, there were some private lenders that were not willing to go all the way. In short, some of them were pulling back. Imagine if we didn't have the Federal Reserve step in, most of us wouldn't have been able to purchase houses. Interest rates would have been record high. So in cases like that, it provides liquidity and it helps stabilize the mortgage market. So for those of you that are investors like me, it's a major impact, because this will affect your borrowing costs, it will affect your underwriting, it will affect your acquisition costs. Anything about purchasing a deal, acquisition or acquiring a deal is going to affect it, and as well as the interest rates that you'll be buying in, and whether that property is going to cash flow. It's going to have a massive effect if the Fed either steps in or they do not step in. Depending on what they do, that will determine how good or how bad a deal can become. Even a little Fed's move creates a ripple effect in the multifamily industry. So this is why I'm emphasizing that any move they make would have a ripple effect on the mortgage-backed security. So what's next? There's really no confirmed plan for the Fed to step in just like they did in 2008 and in 2020 to start purchasing mortgage-backed securities, but there's a news out there, and like I said, there's no fire without a smoke. So you need to start paying attention to exactly what that will look like and for you to take advantage of it, because once the Fed steps in, that means mortgage rate is going to go low, and that might be a good time for you to start refinancing or for you to start buying properties. So you need to pay attention to that. Looking at where we are currently with record high low unemployment and trending inflation is ticking up. History shows that these are periods whereby when the economy is in stress, the Fed steps in to start purchasing mortgage-backed securities. So it's possible that if this unemployment crisis keeps going up and inflation starts ticking up, the Fed might just likely come in just like what they did in 2008 and in 2020. But yet to know if that is going to happen or how bad is unemployment, because the unemployment has been very bad. So we don't know what that will look like. Let's watch out for that. It's possible that that might make the Fed to step in. But for now, don't get your hopes high. So what has been happening, like I said, they've not been getting a lot of involvement in purchasing those things, and at the same time, regardless of whether they want it or not, they'll still remain one of the major players, because those ones they've purchased previously will still be on their balance sheet. So regardless, they're going nowhere. So in wrapping up or in summary, as a borrower, what should you be looking out for? Don't expect that the Fed is going to jump in to save the world like a Superman like before, especially when there is no crisis. History has told us that it's only when there are crises or when there is a crisis that's when they step in to buy these mortgages. As a borrower, don't get your hopes high. It might not happen. But with this current administration, they're kind of trending towards low interest rates and also supporting the housing market. With them, we never can tell, maybe there might necessarily be a crisis for them to step in. Be in the lookout for it, borrowers. And secondly, for you as an investor, what should you be doing at this time? As an investor, you need to start tracking the Fed's balance sheet. You need to start seeing the movements that's going on, because it's with those movements you'll be able to understand exactly what direction the Fed is going. Because most times they don't come out and announce it. It's a quiet movement. But if you're as an investor, you look out for information, you are concentrating and following the balance sheet, when those moves happen, you will be aware. You'll be the first to take advantage of it, because the quiet hands of the Fed is still shaping financing costs and housing liquidity more than most people realize. So open your eyes and look out for the balance sheet. I look forward to seeing you on my next episode. Once again, my name is Bibi Ofiri, and bye for now.